All right, day 2 of the Fed meeting, and there has been some discussion about the Fed cutting rates in the future. So what happens to the markets after the first cut of a rate hike cycle? Mike Santoli joins us with more on this. What does happen?
Well, what happens after, typically, and there's wide variation in this, is good. There's a reason that you say don't fight the Fed. But I think what's more relevant right now, since we're projecting ahead and anticipating, is what happens before the first rate hike of a cycle. In other words, what are the conditions that the Fed would be responding to in its first easing move of a cycle? And that typically is a little bit of a tough sled for the markets, right? So on average, if you look all the way back on typical Fed cycles going back to the 1920s, Ned Davis research says the market is typically, the Dow is typically down about 8% in the 6 months before the Fed has eased for the first time. And if you look at the last few cycles, it's been down typically, let's say 5 to 15% from its all-time highs. Again, wide variation around this. And the last couple of times, which would have been 2007 and 2001 with the first ease, you were pretty much in or close to a recession at that point. But there are these other examples when there was a successfully executed soft landing. If you look further back to 95 and 98, 1995 is the magical year everybody wants to point to. The Fed in 94 kind of over-tightened, or realized they perhaps over-tightened, went up from 3 to 6% on the Fed funds rates in a year, and then backed away very quickly in 1995 and sort of, I guess, took its foot off the brake. GDP actually kind of scraped near zero, at least on first report back then, and you had a little bit of a scare. So I think that's the lesson. You're going to have some kind of significant growth scare before the Fed does anything.
Right, the Fed is usually after the fact.
It's responding to something, right? And I think that is pretty much the lesson right here. And that's why I think, really, I don't think anyone's actively hoping that we get to the moment when the Fed is easing,
right,
even if you think they went too far this past time.
Probably,
exactly.
Right?
Yeah.
Right. Like let's not cross our fingers.
Yeah.
But if you believe in the average moves, according to Ned Davis, we should be declining at this point in the stock market, anticipating that cut later this year.
If you think it's going to happen later this year. And again, by the way, in 2007, it was September 2007, the market hadn't really struggled that much to that point. The stock market did fine. And after the first cut, actually, you went up to make a new all-time high within the next month or so before it all fell apart.